Okay, so as you may recall, we did the income statement and the statement of owner's equity for Yellow Pad Company last time. We also did the gross profit percentage and the profit margin ratio. And now it's time to look at the balance sheet. So the balance sheet, okay, shouldn't be year-ended. Okay? The balance sheet should only be for a specific day. Even though it's usually done with the other statements, it's really just a snapshot. Okay, and what it has to do is report the assets, liabilities, and equity of the company. So what it has to do is it has to reflect the accounting equation, which is assets equals liabilities plus owner's equity. And that makes sense, right? Because we know that assets are economic resources that provide a future benefit. Liabilities are creditor claims on those assets, and owner's equity is the owner's claim on the assets. So it only makes sense that this should balance or equal. Okay, so what we need to do here is, okay, we need to list our assets, our liabilities, and our owner's equity, and our total assets should equal our total liabilities and owner's equity. So what we're going to do is we're going to look up at our data, and we can see that our assets include cash, accounts receivable, prepaid rent, land, building, and machinery. So those have to come down here onto the balance sheet. This is called the report form of balance sheet, where we just have one column of numbers. There are other formats for the balance sheet. So we have cash, we have accounts receivable. And remember, accounts receivable is an asset because it is payments that we expect from our customers. A receivable does not mean we're receiving money. A receivable means that a customer owes us money, right? So we expect to receive cash from a customer in the future, okay? And then I believe we had prepaid rent. So prepaid rent. And then we had land. And then we had a building and machinery. So these should be listed in order of liquidity on the balance sheet. And liquidity means how quickly can I turn something into cash. So cash, of course, is cash. That's our medium of exchange. But it should be a lot easier for me to turn a receivable into cash than land. Okay, chances are my receivables are going to be due within 30 days or so. It'll probably take me longer than that to sell land or a building. So receivables are more liquid than most other assets, okay, other than cash. And there's one called marketable securities, which are very short-term investments. But most small businesses wouldn't have those. So we have 180 for the cash. We have 95 for the accounts receivable. We have 24 for the prepaid rent. And prepaid rent, prepaid insurance, any prepaid expense just means I'm paying it in advance. That's why it's an asset, because it's providing a future benefit. If I was just paying it monthly, it would be regular old rent expense, right? But because I'm paying it in advance, I have a future benefit, which makes it an asset. So land is 20,000. Building is 28,000, I believe, and I'm sorry, 280,000, and then 145. Okay, so our total assets now are going to be 744,000. So we already know what our total liabilities and owner's equity should be. It should be this, right? So our liabilities now are going to include things like accounts payable, which mean you owe vendors money, right? And these are normal, everyday parts of business, right? Okay? You know, when my father owned the auto parts store and he would deliver parts, he had hired a guy to deliver parts to garages and and dealerships and things like that, you know, they would sign a packing slip that they received the parts, and then my father would bill them later, right? They weren't there with a check waiting for the parts. So receivables and payables are normal parts of business, and they're almost always short-term. Okay, so we have accounts payable of $240,000. Income tax payable of $112, I think it was. Yeah. And then we had a note payable, which is probably a longer term liability. Okay, a note, the difference between a note and an accounts payable is a note is something you'd have to sign probably at the bank, and would have an interest rate, it would have a term, you know, you'd probably have to make regular interest payments. You know, it depends on the terms of the note. But it's usually a formal thing, where an accounts payable is less so. And that note was $167,500. So these are our liabilities. These are creditor claims on our assets. So what we need to do is add that up. So we have total liabilities of $519,500. Now, in a sole proprietorship or an LLC, the equity is represented by the owner's capital account. And we started with 0. So we started with 0, okay, but we didn't end with it. Because if you recall, we did the statement of owner's equity. And once we took the net income and subtracted the owner withdrawals, we came up with $224,500. So that's going to be the capital that goes on the balance sheet. Because as of December 31st, that's the capital. And on January 1st, 2022, this will be the beginning capital, right? So in order for me to make sure the balance sheet is in balance, now I'm going to take my total liabilities and I'm going to add my owner's capital. And it is. So the balance sheet reflects the accounting equation. It lists my assets, liabilities, and capital. We have to make sure that the accounting equation is in balance. We have total assets equal total liabilities and owner's capital. And it also lists these accounts for us. These are permanent accounts. They go from period to period, where income statement accounts are only designed to measure activity for one period. So that's kind of the difference, right? So what do we do with the debt ratio? Well, the debt ratio is designed to tell us what percentage of my assets are financed with debt. That's important for me to know, for a bank to know, for an investor to know. If I have a high debt ratio, I may not want to take on more debt. I may want to work on paying some of it off. So how do I figure out the debt ratio? Total liabilities divided by total assets. So for this company, our debt ratio is going to be the $519,500 divided by the $744,000. So they're going to have a fairly high debt ratio of 70%. So that means out of every dollar in assets they have, 70 cents of that has a creditor claim. So creditors have 70-cent claim for every dollar in assets we have. Okay. Now, that's kind of high. It may be normal in this industry. We don't know. You know, one thing you can do with a debt ratio is you can check your industry. Like banks have a very high debt ratio. That's normal. If you have the same debt ratio as everyone else in the industry, you know, that's probably okay. You can also check it from year to year, whether it's going up or down. Okay, so, but it's important information that you need to have. So So that's the balance sheet, and it goes along with the other statements. And later in the course, we're going to look at a lot more financial ratios that will give you a quick look at, the financial condition of your business. Thank you for your attention.